Things in China have gone from bad to worse. I'm your host, Steve Van Metre, and thanks for joining me today. And China's banks are facing $350 billion in losses that could topple their entire banking system. Let's over to Bloomberg, where we picked today's story up with this headline that China banks may face $350 billion in losses from this ongoing property crisis as mortgage boycotts and slowing growth are rattling authorities. China's banks face mortgage losses of $350 billion in a worst-case scenario as confidence plunges in the nation's property market and authorities struggle to contain deepening turmoil. A spiraling crisis of stalled projects have dented the confidence of hundreds of thousands of homebuyers, triggering a mortgage boycott across more than 90 cities and warnings of broader systemic risk. The big question now is not if, but how much it will batter the nation's $56 trillion banking system. And that is the real story here, because we remember in America what happened when our financial system came under fire due to mortgage loans going bad and people stopped paying on them. Now people in China are making the same choice, but many people don't think anything bad could happen. A worst-case scenario is S&P Global Ratings estimated that 2.4 trillion yuan, or $356 billion, or 6.4% of mortgages are at risk, while Deutsche Bank is warning that at least 7% of home loans are in danger. So far, listed banks have reported just a mere 2.1 billion in yuan delinquent mortgages as directly affected by the boycotts. Banks are caught in the middle, as we've talked about. If they don't help the developers finish the project, they would end up losing much more. If they do, that of course would make the government happy, but they add more to their exposure to delayed real estate projects. And the reason this is happening is because China's real estate market is effectively a Ponzi scheme. Developers right now are broke and they need new buyers to finish homes that aren't completed. And people that are buying homes have to buy uncompleted homes and get mortgages on them and make those payments. So with developers broke and buyers don't have a home, you can see that both sides are at odds, putting the banks as losers either way. Either they lend to the developers who need to finish the homes and they take the risk, or everyone stops paying and the whole thing comes crashing down. The exposure of Chinese banks to the property sector tops out of any other industry. There were 39 trillion yuan of outstanding mortgages and another 13 trillion yuan of loans to developers at the end of March, according to data from the People's Bank of China. The real estate market is the ultimate foundation for financial stability in China, and that could be a problem, as Chinese banks have raised a record amount of capital in the first half from bond sales as they prepare for a potential spike in soured loans. So rather than deal with the problem, what China's banks have done is taken on even more debt. So if this doesn't get resolved, and maybe they're hoping the government steps in to resolve it, well, not only are developers going to potentially fail, and home buyers are maybe to lose their job as the economy slows, but now banks saddled with even more debt could face an all-out annihilation. And bank earnings are at stake, if nothing else. After recording the fastest profit expansion in nearly a decade, the nation's lenders face a challenging 2022 as government pressures them to support the economy at the cost of earnings. And it's not bank earnings that are at stake, it's the entire Chinese financial system and the global economy. But if you're concerned what that means to your portfolio, well, you shouldn't be. There's one that stood the test of the great financial crisis. That's called Portfolio. I'll put a link up there in the description and the description below. Let's continue on, because things in the U.S., well, they're not looking too hot either, as U.S. jobless claims rise again, near highest since November, as the stock market goes bonkers. Applications climbs 262,000 after a prior week revised lower, and the 4-week moving average is also heading higher. Continuing claims for state benefits ticked up to 1.43 million in the week ending July 30, the most since early April. Jobless claims have been rising as more companies, particularly in the tech sector, announced layoffs and freeze hirings due to economic uncertainty. Demand for workers may drop as the Federal Reserve raises interest rates, but so far employers are largely trying to hold on to the ones they have amid widespread labor shortages. But is there any evidence, is there any connection between the federal funds rate and unemployment? Well, let's take a look, because here we have the 4-week moving average of initial claims against the federal funds rate, that in red. And what we can see is there's not an entirely large relationship. Yes, it tends to be that the federal funds rate rises and then unemployment claims rise, but is there a direct connection that employers are looking at the federal funds rate and laying off employees? Not really. It has to do with the banking system, because when the Fed raises rates, it slows credit growth, or ultimately leads to slower credit growth. Here we have the federal funds rate still in red, overlaid against loans and leases in bank credit at all commercial banks in blue. And what we can see that as lending is headed higher, which is creating money into the financial system, and the Fed starts to tighten to deal with inflation, it slows the growth of loans. And we see that happening over and over again. And that's the real issue, is just slowing down, the amount of new money created. And we can see that in the money supply, because when the Fed raises rates, it unwinds their balance sheet. It tends to slow the money supply growth down quite a bit. And now we're going to overlay the M2 money supply in blue, keeping the federal funds rate in red. And sure enough, what we see is now in the modern economy, as the Fed raises rates, yes, the money supply could rise, but those higher rates and that slower credit growth eventually lead to a slowdown in the money supply. We see that happening going into the great financial crisis, where then it ultimately came down. We see it happened in 2015 through 2018, late 2018, as the Fed raised rates, it slowed money supply growth. Is happening again. And what's notable about where it is right now, between 4 and 5%, that is consistent with areas where we see recessions. And that's not good news, because right now everyone's hopped up that the stock market is heading to new highs and then some, but rising unemployment claims suggest the opposite is going to happen. Here we have the Wilshire 5000 now in red, overlaid against the 4-week average of initial claims, that in blue. And what we see is nearly a mirror of them. So as claims head higher, yes, you can have a rally in the market, as we're seeing now. But if claims continue to go up, that rally will be short-lived and lead to lower stock prices. And while interest rates are heading higher, at least in today's trading and over the last few days, rising unemployment claims suggest that as we look at treasury yields, they too are likely to head lower. And yes, there are times, as you can see here during 2008, where yields can rise up and then head crashing lower. It's not unusual that going into rising claims, investors try to push rates up, and that leads to an all-out crash in yields. And something else that's starting to head lower is producer prices, as we see this headline. The U.S. producer prices fall for the first time since early in pandemic, as the index fell 0.5% in July from a month earlier. And a key measure of the U.S. producer prices unexpectedly fell in July for the first time in more than 2 years, largely reflecting a drop in energy costs and representing a welcome moderation in inflationary pressures. The producer price index for final demand decreased 0.5% from a month earlier and rose 9.8% from a year ago, according to the Labor Department. A pullback was due to a decline in cost of goods, though services prices only edged up. Excluding the volatile food and energy components, the so-called core PPI rose 0.2% from June and 7.6% from a year earlier. Both overall and core figures were softer than forecast, and it's not a surprise. You keep hearing, oh, there's a surprise here. It's all about the energy sector. Now, just keep in mind, I'm not going to show you any charts of the PPI versus the CPI, because they don't really correlate to each other that well. But look at the energy sector here. Let's look at West Texas Intermediate in red on a year-over-year rate change, and we'll compare that to the producer price index in blue on a year-over-year rate change. And look at that. You see the energy sector, as it heads lower or its growth slows down. Look what happens to producer prices. They go down. And sure enough, the energy sector is heading down. That means producer prices are coming down. That means inflation is coming down. And according to our chief strategist, who no doubt will be talking about this in his daily coming up tomorrow, when I'm sure he'll cover producer price index, Jeff Snyder says this about consumer prices: while it may have taken longer than most people would have wanted or could afford, and the rolling over wasn't ever going to be nice, a clean single month top, there continues to be more than not indicating the Fed was wrong to have turned its back on transitory, and is more likely after today to regret having done so, because the reason for the rolling over isn't rate hikes. And what he's trying to suggest is the reason we're seeing, of course, the consumer price index come down, we're going to see the producer price index come down, and possibly the Chinese banking system come down as well, along with the U.S. economy, as we have a dollar shortage. And the Fed, by hiking rates and unwinding its balance sheet, isn't making that any better. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.